Institutional capital markets are signaling a period of extreme optimism in July 2026. Major Wall Street banks are reporting strong results, supported by a surge in trading and high-level deal-making. Substantial fees from a pipeline of initial public offerings are bolstering investment banking revenue. This performance highlights a robust appetite for risk among institutional investors, even as concerns regarding valuation sustainability persist. This financial momentum exists alongside a physical reality that is far more strained. The human and operational layers of the global economy are fracturing as the friction of real-world logistics begins to slow digital progress. The coming years will be defined by the feedback loops between technological ambition and macroeconomic constraints. Technological growth is currently hitting a ceiling made of energy, labor, and silicon. Mapping these interactions requires a framework that accounts for both technological catalysts and macroeconomic stress. Our analysis tracks two primary vectors: macroeconomic stressors that act as a choke point for technology, and the ways technological shifts are themselves driving broader economic volatility. A clear understanding of these specific intersections has become the baseline requirement for corporate survival over the next decade. The primary macroeconomic stressor currently destabilizing global supply chains is the effective closure of the Strait of Hormuz. This localized military tension has triggered a global energy shock. As crude oil prices surge, inflationary pressures are mounting, forcing governments to brace for prolonged disruptions to energy security. Energy-intensive chemical processing means this shock passes to agriculture via rising fertilizer costs. Tight energy markets are a direct threat to global food production. Vulnerable developing economies face the highest risk. Rising food prices and potential supply shortages are creating a precarious environment for regional stability. The technology sector is equally vulnerable to these physical constraints. Heavy capital expenditure cannot solve the problem of a broken logistics network. Semiconductor fabrication is one of the most energy-intensive processes in modern industry. As power costs rise and logistics for chemical precursors fail, hardware constraints become a persistent reality through the end of the decade. In our framework, we link the energy shock directly to these hardware bottlenecks. The physical world is setting the pace for the digital one. These bottlenecks limit operational capacity across the tech sector, driving up component costs and delaying infrastructure projects. This creates a secondary wave of systemic inflation. The physical constraints of energy and silicon have placed a hard cap on digital expansion, illustrating the first pillar of our matrix. We see a similar restrictive pattern when we look at the human element of technology deployment. High levels of corporate investment in artificial intelligence are failing to yield the expected efficiency gains. While spending on AI tools is scaling exponentially, organizational output has begun to flatten. Organizations are reporting a significant friction point: widespread cognitive exhaustion. Employees are struggling to integrate these tools at the pace demanded by their firms. Human cognitive limits now dictate the absolute binding constraint on growth. Computational power is abundant, but the capacity of the workforce to utilize it peaked. This human-level friction connects to broader industrial instability. Leaders in the automotive and industrial sectors are monitoring labor negotiations as contract instability threatens production output. Firms are being forced to reassess their strategies. The focus is shifting from rapid implementation towards sustainable workplace integration to protect the underlying human capital. Enterprise value is being eroded, where the human operational layer cannot keep pace with technological acquisition. Large multinational enterprises are responding to these compounding costs by fundamentally altering their operational structures. Traditional growth through mergers and acquisitions is facing increased antitrust assertiveness. Legal challenges from state-level regulators are forcing companies to consider drastic restructuring or relocation. This regulatory environment and rising energy costs create volatility in emerging markets. Indices like the Sensex reflect this cautious sentiment as investors weigh geopolitical risks. Blocked from simple acquisition-based growth, enterprises are scrutinizing the unsustainable cost structures and legal risks associated with proprietary AI models. This scrutiny is accelerating a strategic pivot. Enterprise buyers are moving toward open-source artificial intelligence architectures as a survival tactic. This shift directly threatens the dominant pricing models of established technology giants, as cost-efficient alternatives begin to challenge industry standards. Brute force cost survival is driving market democratization, altering the flow of capital independently of ideology. The resulting feedback loop shows how technology and macroeconomics have become mutually restrictive. Global institutions are signaling caution. The International Monetary Fund has trimmed its growth projections, noting that energy market instability remains a primary drag on international economic momentum. Developing nations in Asia face acute fiscal pressure. The cost of maintaining fossil fuel subsidies is becoming unsustainable, forcing a transition toward more targeted, limited assistance. Central banks are reacting by shifting reserves away from the United States dollar. They are moving into gold at record levels as a strategic hedge against this geopolitical uncertainty. This defensive posture extends to pension funds. Japan's government pension investment fund is being encouraged to increase its investment in domestic assets, providing a significant weight to offset external market pressures. Our 3 to 5 year forecast suggests a fragmentation of the AI landscape. Expect enterprises to standardize on open-source alternatives as proprietary costs become prohibitive. A broader decoupling of capital will continue. Large, unified networks will fragment into decentralized clusters as nations and firms focus on localized survival. Localized supply chain resilience and sustainable human integration will define the economic moats of the late 2020s. Rapid technological acquisition is no longer enough. The winners will be those who can operate within these physical limits.